people have sort of said, how come you're speaking today? Because I am not a CIO or a chief executive for the single family office, nor do I run any money. But I've done all of those things in the past. So I've run money, I've run 2 or 3 private banks, and I built a family office. And the reason I'm here is as I sit on the board of 3 very different family offices. I not only sit on their boards in terms from a governance point of view, but also on their investment committees. So I have sort of insights which I think Landytech thought would be interesting for me to share with you. So, what am I going to cover? Just a few words on the big picture, then talk about what I'm seeing happening in asset allocation. I'm also going to touch a little bit on ESG, because it's on the agenda for the family offices. And then the trends around further professionalisation of the investments engine in family offices, things that I'm seeing on the government side, operating models, and a little bit about reputation. So let's start with the big picture. There's lots going on, lots of events. We all know that there are 40 global elections this year, but very few surprises. Kind of like in the States, it's most likely to be Trump, but it could be Biden. No one seems to care very much at the moment. We've got political instability in more parts of the world than we have for a long time. And nobody's that fussed about it, or they're learning to live with it. So there's nothing other than the geopolitical instability and insecurity about elections isn't sort of affecting people's view of what's going on. The consensus is inflation is falling, but kind of not enough to stimulate growth, and fiscal policy restraints as such, that's a bit of a worry. Interest rates are expected to trend downwards other than in Japan, and the nuances around what speed and how long will it take. And people are watching the Fed every time they open their mouths as to try and guess what's going on there. So economic growth there's a slightly less supportive policy environment, and the big question on the agenda of investment committees is what's going on in China. Will they pick up the slack? So what does that mean in terms of strategy? So what I'm doing here is telling you not one person's asset allocation strategy, but a mixture of what I see from the different people that I work with. So cash, people started last year with a bit too much cash, but were cautious. They hung on to it, but by the 4th quarter of last year, they started to put that cash to work and got predominantly back into tech in the US. But still, cash at 10% is quite high. From underweight to neutral in investment grade fixed income, and less so in corporate high yield bonds. We'll move away from that. Interestingly, a mixed view on commodities. In the States, family offices are much more overweight commodities, and most people have taken the view that even if they don't really understand what's happening in Bitcoin, with the political instability of what's going on, why not have a bit of gold and some Bitcoin as well? Because now that we've got ETFs, it's much easier. But there's less hype around what should we be doing with that asset class. Interestingly, in terms of developed market public equities, most people have been underweight, and what I've seen happening in portfolios is a reduction of beta. Most people are now feeling with what's happened in the markets, they're switching in their portfolios to more industrials, fewer consumer, less tech. And from a geographic point of view, Japan is a really interesting outlier there, and some people have done incredibly well. I'm very blessed in that I chair the European part of a very large hedge fund called Point 72, a macro manager. So I get some really interesting insights as to what the thinking in Japan has been the surprise there, and certainly people have done incredibly well. In terms of emerging markets, it's kind of neutral, that people are adding to Asia. India, they'd like to add more, but they don't quite feel comfortable. And very big split views on China. I sit on one investment committee where actually we've had a really, really shocking time in China. And the big debate now is, do we dumb it down? And how long-term view should we take? We haven't reached the conclusion. The meeting is next Monday. I'll let you know. So what about alternatives and illiquids? Very big debates on PE. Most single-family offices still take that long-term view and are prepared to not panic about the fact that interest rates are challenging some of the higher interest rates are challenging some of the returns, but also the poor IPO market is such that it's going to take longer to realise that we're getting their money back. I see US family offices much more bullish on private equity, but within Europe and the Middle East, I think there's not the appetite out right now, but nobody's reducing. Very interesting though, in venture capital, there's still a focus on tech and AI. I'm a bit surprised at the resilience of what's happening to underlying companies. That a lot of people thought there'd be bigger write-downs, bigger needs for cash, and quite impressed. I mean, it's a terrible generalization to say, and I'm talking about the three big clients that I work with, that probably they were prepared and had a cash buffer, expecting bigger needs. And certainly on the tech side, now that you've got more realistic valuations, there's a sense that you must not miss out a vintage. You've got to keep going, but be careful about your waiting. Private credit has been flavour of the month for the last 12 months. A lot of people were a little bit behind. It was a new asset class to understand the different nuances. But, as banks are withdrawing from lending, this is an asset class with good, risk return profile. Infrastructure, very interesting. Again, US, much more interested in what's going on there. There was a sense this time last year that why do I need infrastructure when I can have credit, I can have fixed income, I can have real estate, I don't really need this sort of peculiar asset class. But actually I think people are really looking at that and thinking that they like the lack of correlation, that steady income coming through. Real estate, again, depends where you're starting from, depends how much you already have. Clearly not clearly, but the families that I work with, they love the asset class, quite worried about what's going on in terms of office and commercial, particularly in the UK. More question marks about, gosh, what about the UK? What's going to happen under a Labour government? Maybe a bit more focus on the States and the resurgence of the family office. So that's the picture as I see it. So it's kind of like people wishing that the markets were a bit more attractive in terms of valuation, but certainly portfolios are more diversified in terms of sectors, and people are looking at that. I would also say that there is, but actually I think I come on to it on the next slide, so I'll keep quiet about that. ESG, big topic. So we saw the sort of bull market in ESG from the product side, lots of people wanting to sell these ESG products, and that's kind of normalized. I mean, I think there's an acceptance that good stewardship is a long-term play in terms of it is a good thing to invest in companies that are doing the right thing and have all the right governance, blah, blah, blah. You don't get that in the States. They're much more hard-nosed about it. They don't have the same pressure from the next generation to really be worrying about that. And I think you read about, and I think it depends on your political leanings as well, but I think there's nervousness about taking too much of a view. Whereas I would have said a year and a half ago, and in particular, I was on the board of a Canadian company, there was a much bigger push of people who had backed off. There isn't a day or a week that goes by without us having to think about greenwashing. It's all over the press, and it's tough. I mean, when you dig down and you look at what's going on in these funds, it's really hard to have a standard measure. It's really hard when the guidelines aren't out there. But I think because there's more scrutiny and because people are backtracking from it, I think that you'll get better answers. But the debate is nuanced. It's such a grey area as to where good becomes not good, whether you should actually invest in a company with not an ESG score, good ESG score to help push them, and because they're going to change their strategy and really better. Those are really tough discussions for investment committees, and they're really tough if you've got trustees on the board because they're terrified. Most trustees don't want to be sued, they don't want the next generation to make them feel that they've done something wrong. So there are lots and lots of debate around that. Next generation is certainly putting the agenda around philanthropic and social investing. There is absolutely no doubt that since COVID, the inequality in the world has grown, and most families who have money are even better off than they were before. And there's a real sense of how can we make this money work better? How can we make sure that we move from saying let's not invest in bad things to actually let's invest in stuff. And I can give you one example where we've designed a portfolio. Instead of having a separate impact bucket, we've actually tried to measure and put impact across each asset class to look for ways in which we can put some of that asset class into vehicles where you might have a slightly lower return that have a greater impact and actually increase the risk of the rest of the portfolio. So I've got a live example of working on that. Tiny bit of advice. I apologise to any of you in this room if you're on the sell side and have some products that you're selling to some of these family offices. But one thing that I would like to share with you is that when you meet companies and you talk to them about their ESG, it's much easier to get a good sense from them as to what they're doing. And you can have your own measure at the end of it. What do you do when you've got a hedge fund or a private equity fund? You're one removed, your manager's coming to them saying, yes, here's my criteria that, I tell this private equity fund that they've got to tick all those boxes. I turn around to those managers and I say, tell me the criteria that you use for these funds. And they tend to, and I go, okay, go back and rate yourself as an organisation against that criteria. Are you actually walking the talk? Are you doing it? It's the only way, once removed, that you know that it's part of their DNA, and it's not a box-ticking exercise. And it does make people wake up when they have to actually tell you exactly what they're doing in terms of equity, pay, diversity, and all the stuff they want other companies to do, but they haven't got time to do themselves. So that's a little tip that I can give you. And something you get much better answers. So that's the kind of investment bit. What do I see happening around the investment engines within the investment bit within family offices? I think there is a greater focus on portfolio construction and of hiring really good experts who know how to put a good portfolio together. What we've seen is portfolios over-diversified, that you kind of got all these brilliant managers and you balance value with growth and your sector, and you think you've got the perfect portfolio, and then actually when you analyse it, half of it's benchmarked. And it's kind of this thing of, I need to sweat for every basis points of performance right now. I've got to sweat it in fees, I've got to sweat it in terms of portfolio construction. And part of that is actually a move, again, the states I think are a bit ahead about putting a lot of beta in the portfolio into ETFs, passive vehicles. it is a bit challenging for some CIOs, apologies to those of you that find it challenging, because it's like, I am good at finding fund managers and I can put them all together. The reality is, most people do underperform, so you have to be really, really good, and it's not shameful to have ETFs in some markets, and that debate is taking place, particularly at senior levels, and views around their recruitment, how much they outsource, how much they're doing in-house. Also a move in investment committees. So it's a terrible thing to generalise about, but if you take really long-standing family offices, let's take the Grosvenors in the UK, they've got a governance structure that has NEDs from generation to generation and a real kind of governance of a public company. Newer family offices tend to have the people that they know and they might have worked with in a bank, and retired people who are not necessarily at the money and experienced enough. There's a big upgrade there. There's a recognition that families, family offices, and the teams within a family office really benefit from having an investment committee that they can call upon and actually use as a resource, not as a threat to double check what you're doing, but as a resource to enhance what you're doing. Because again, everyone's searching for alpha. I've also noticed that there's a slight trend, and again, terrible to generalise, to move away from tactical asset allocation, more to rebalancing, because it's so bloody hard to get it right. People are really good at deciding to get out of the market. They're pretty poor at getting back in. This is now my plug for Landytech. There is also an investment in upgrading reporting and performance analysis. And in fact, I worked last year with one of the big clients who did a real analysis of what was out there, how they could include risk, how they could include good attribution analysis. They don't manage money themselves. And I'm pleased to say that they did appoint over. The other thing that I'm also seeing is that people are building their expertise and focusing their investment spend in-house on a particular area of expertise, particularly around VC. And why they do that? They're doing it to get an advantage when it comes to getting the good co-investment deals. You want to be attractive to a private equity house, to an actual investment, that they want you as the shareholder, because you're a long-term shareholder, but you bring something to the party. So there's a lot of, let's focus on an area and let's partner with other people who have other expertise and kind of build a network there. So a lot of that thinking is taking place. So what's happening on the governance front? 2 or 3 years ago, people used to talk about planning constitutions and putting all that in place. That's still there and really important. But what I'm seeing now is, again, in that search for talent is actually family offices looking at themselves as a business and being able to articulate both their mission and their strategy to make sure it's aligned with the family and their values. And that's a way that, if you're trying to attract the top talent, which obviously everyone in this room is, you have to be able to make sure that you've got a competitive advantage. So as I sit on the boards of those families, these are the sort of conversations that we're having that helps you attract and retain the best talent, but also the best deals. And I come on to the fact that, privacy now and hiding behind a wall is no longer the case. You can't do that anymore, and for very good reason. So there's much greater transparency, and I think that's an ongoing thing, particular 2 family offices, but they might have been a bit later in the process, the ones I work with, of really making sure that the protocols, the processes, the communication with shareholders is just better and more transparent. And this move, I was talking about the Grosvenors. As more mature family offices are thinking about succession planning, many of them are thinking about, do you know what, I've got my investment advisory committee, I do need a few non-exec directors. I need it because there needs to be something independent, somebody who can broker the next generation, and my generation as a founder or Gen 2, and it has to be somebody who's going to be impartial. It's also recognition that the families that have had the biggest challenges are often the ones where it's been difficult to speak truth to power. Most employees, it's really, really hard to turn around to someone and say, I think that's a terrible idea, because you risk your own job. And a non-exec director who, again, is impartial, can help broker that. And I've seen more interest in that area of governance. How am I doing for time? Am I okay? Operating model. Again, discussions here around the fact that single family offices, while they're being seen more as a business, they have been cost centres. And actually flipping that round and thinking about, should I not necessarily become a multi-family office, but should I be an investment holding company? Should I therefore be able to offer some of my products that I have to other families and third parties? Why should I try and do that? And because the costs of running this are huge, my talent that I want to attract has a stake in, let's say, the real estate business or the private equity business, but actually they could go and work for a real estate company or a private equity company where you're amassing more AUM, and therefore they'll have higher take-home pay. So people are looking at that and thinking, should I, and predominantly these are families that have sold their family businesses, and what their investments is their sole business that they have left, thinking, do I turn this into something that can make more money? There are huge challenges doing that. The alignment of interest is so important between what the family is looking for and the people that they're inclined giving the estate to. I think some families underestimate the regulatory headaches of suddenly having to offer money to other professional investors and what that entails, and something called cloud service that they're not used to because they're the only client. So all of those sort of debates are taking place around the table, and then asking the question, I don't think I want people to know as much about what we're doing, because your privacy will be intruded if you start offering their money to third parties. I had a conversation earlier with somebody who come from Madrid, Venezuela, talking about people actually thinking about outsourcing to third parties. People thinking about setting up their family offices who kind of go, I don't have the time to run another business. I'm a time-poor entrepreneur. It's another management, another headache, but I don't have enough money to have my own family office. So kind of thinking about outsourcing it, but not really wanting to go to a multi-family office, because they want somebody with independence around the investment. So I think there's a trend there. I hear more people talking about it than actually doing it, but I think it's developing. So I'm going to end talking about an investment that most people don't think about. Again, has been a very big agenda item. It's a good segue to you, Laurent, because we're going to talk about AI. But AI has really made people wake up in terms of what's going on here. AI and the fact that a number of families are not necessarily getting the deals or the amount of the deals that they would like to. So, if you think that privacy now is a luxury. There is no way, and in fact it's actually scary. If you Google and try and look at a family right now, if there's nothing on them, that's serious. You're either a drug dealer in Bolivia, you're an oligarch in Russia, and you've covered up all your dirty stuff. And actually, you need to think about investing in your reputation. That's not telling the whole world about everything that you do, but actually saying what you're about as a family and as a family office. It is a valuation booster like any business, and actually, creating that brand is an important component. It's also a shield in times of crisis. How many of you have read about the Barclay brothers in the last few years all over the front page? Well, that was a family that consciously kept privacy right out there, never had any friends. So when it hit the fan, my God, the press were at them. Nobody needs that. Nobody needs that. So it's always quite good to have that. It's around, is what I said, it helps you get good deals. People think of you as a good organisation. You'll be higher up the list than somebody else. Can be a unifying force for the family, and it certainly can help in philanthropy. Again, philanthropic donations now, the due diligence process is phenomenal. I'm Vice Chair of the Royal Academy of Arts, and I can tell you when anyone wants to give a donation, we have to check all the way through that, your surname isn't Sattler, and all those other issues. So how single family offices doing this? So actually, they're like a business, they're thinking about a core brand attribute, and actually the advice I would give is don't try and be all things to all people. Get known for something absolutely, and particularly if it's something to do with your DNA. It's also about being patient and authentic. You can't bullshit on this stuff. If you just, it's a bit like the greenwashing ESG. If you don't actually walk the talk, there's no point doing it. Building the digital presence. Coming back to AI. If any of you know Digitalis, I attended a talk then. It was really quite scary about how the hallucinations that can take place, you need to scrape your identity all of the time and check there's nothing out there that people have by mistake associated you with. And this is a real worry for families who security is important to them. And security is not just their physical security, it's their emotional security, and it's their reputational security. And interestingly, that's come onto the agenda. So this is the last point around AI-generated falsehoods. What I had to say.